Hello and welcome to CMC Markets Trading Outlook for the week of February the 29th, 2016. My name is Colin Szynski, Chief Market Strategist. This week we're going to look at changing market trends, a big week for data, and interest rate speculation in the U.S. and Europe. We're over the last couple of weeks, we've seen a real transition in the markets. For the first 6 weeks of this year, markets were under very heavy selling pressure, but a couple of weeks ago, they started to show signs that the downward pressure was nearing exhaustion. Over the last couple of weeks, we've seen signs of bottoming, and now we're starting to see signs that these new recovery trends, in particularly in stock markets, are starting to take hold. We're also coming off a week now where we saw exhaustion and peaking in defensive plays, such as the yen and gold, and those are also starting to reverse, going back the other way. It's a busy week coming up for economic news. We've got we've got manufacturing PMI, service PMI. We've got GDP reports still for a number of countries, including Canada and Australia. We've got employment reports for the United States and Canada, as well as Germany. We have Super Tuesday is a big day for U.S. primary elections. After that, we should get an idea of who the contenders are for the U.S. presidential nominations and winnowing out some of the pretenders. We've got you name it, we've got it. We've also got a number of reports for Australia. We've got a number of reports for the Eurozone. And everything that we look at in terms of data is going to be people looking for a number of things. First of all, did this market volatility and fears that we had that gripped the markets and smashed them down in the first 6 weeks of the year, has this materialized into economic weakness or not? Were these fears justified or not? And it's interesting as we come out of February here, because we're starting to get some really interesting signs out of the global economy. First of all, some of the things that would drive the markets down previously, higher U.S. inventories would drive down oil, drive down markets. Big declines in China would drive down markets all over the world. But what did we see last week? We had a 6% decline in China one day, completely got ignored. Why? Because they're seeing that this is relatively contained to China, and the stock market gyrations there aren't having an impact on the broader economy. It's struggling, but it's not crashing. Similarly with crude oil now, where we are seeing that it looks as though a bottom's been put in for crude now, even when we had a little higher than expected U.S. inventories last week, they weren't as high as the API report, so boom, crude oil actually starts going up. Talk of major producers getting together and sitting down again and discussing further production caps. That's a positive thing as well. People that go around saying we're disappointed there weren't cuts right away, you can't really expect that people are going to countries are going to go from fighting an economic war against each other and in some ways fighting a proxy war against each other in Syria, to sitting down and suddenly we're all going to get on the same playbook and start cutting production to solve the markets. That's not going to happen. Some of them have been using the lower oil prices to try and bankrupt their adversaries. So really, to just getting them down at the same table and even talking is a step in the right direction. It's going to take time, and a lot of other things take time as well. So we've got all this data. And what's interesting here as we come out of the end of February is things are starting to look up for the U.S. economy, and what does that mean for the Fed meeting? And here on Friday the 26th, for example, we had U.S. fourth quarter GDP revised upward, and even more importantly is the core PCE inflation figures, particularly the monthly number. The January PCE inflation, which is the figure the Fed uses, was up. It went up to 1.7%. It was above Street 1.5. On top of that, the December number was revised upward 1.4 to 1.5%. As we look at Fed comments and U.S. economic data, we're seeing three factions kind of showing up at the Fed. There's one faction, the dovish side, which has said, oh gee, we should stop raising interest rates and because global volatility means the U.S. economy might be slowing, or that the falling oil price might mean that we're heading into deflation and we shouldn't raise interest rates. Then you've got a middle faction that's saying, well, let's keep our options open and see what happens. And then you've got the hawkish faction that says, no, the market volatility is something that happens during the transition phase from dovish to from easy monetary policy to tightening, that this is all normal and it's going to blow over and the Fed should keep raising interest rates. So where have we gone? Well, a lot of the data has been weak out of the U.S. Recently, or at least mixed, and so that's had people wondering, well, which way is the Fed going to go? Well, here on the Friday, GDP instead of getting revised downward to 0.4, got revised upward to 1.0. That was above street at 0.7, so stronger than expected GDP. Higher and rising core PCE inflation. That's probably the most important thing we've seen all week. What does it mean? It means inflation's not going down in the U.S., it's going up. The people that were saying don't raise rates again because inflation's going down, it turns out that they're wrong. Inflation's going up. If inflation starts going up, we're likely to see continued rate hikes in the United States this year. So I still think that, and part of the thing I think we're seeing here on the Friday with the U.S. markets not going up quite as much as the markets in Europe is a growing recognition that a March rate hike is back on the table in the United States, and that's why I think we're seeing some profit taking and some leveling off in the U.S. markets. So, and the other thing we're seeing out of that is this nice pop here that I've got in the chart in the U.S. dollar index. Overall, I still think that the U.S. dollar index has peaked with resistance up here at 100, and the Fed I don't think wants to see it go much above that. I think the talk that was out there about speculation on rate hikes and speculation on negative interest rates and things like that was to keep the cap on the U.S. dollar. U.S. companies are struggling with the rally that the dollar has had. If it starts to come off, that helps them. I don't think the Fed is too enthusiastic about other countries going into deeper into negative rates, bringing their currencies down, and trying to rebuild their economies at the expense of the United States. The Fed doesn't seem to be too happy about that either. I think they left negative rates out there as a threat against the other central banks to try and keep them in line or keep them from going too far into the negative, which is significant with an ECB meeting this month. So I think we may still see the U.S. dollar kind of hang around in this 96 to 100 range. It could continue to climb in the short term. The other thing that's of interest particularly in currency markets that I wanted to highlight here, with the U.S. dollar starting to bounce back a little bit, is also this idea of capital flows between defensive and what let's call cyclical or plays or risk on, risk off. So for the first few weeks of the year, clearly we've been in risk off mode. And what's been interesting here, though, is that with the Bank of Japan here, we had, let's look at the yen, we had this spike up into the Bank of Japan meeting where they cut to negative interest rates, weakening yen. Then we had this dramatic strengthening of the yen. This is as the Fed started to talk a little bit more dovishly. People started to say backing away from the 4 rate hikes this year. And interestingly enough, that sparked the yen. But the other thing we've seen, though, is that the yen has gone up along with stock markets. And what's happened was this kind of fear trade that we've been seeing here that's been pushing the yen higher. Well, now we're starting to see this might be reaching an extreme here. Look at this. There's a double bottom here. There's a hammer candle here. You broaden that out to a down, a hammer, and an up. That's a morning star. So we're seeing signs here that this flood of capital, of fear capital, and people worried about this, that, and the other thing that real or imagined is starting to come to an end. It looks like it's peaked. We've had the yen become oversold twice. Higher low is a sign that downward pressure is easing. We're seeing the yen start to work its way back up again, or dollar yen, sorry. So this is US dollar starting to recover against the yen starting to weaken. Where else are we seeing this? We're seeing this in gold. Take a look at this one. Gold, massive rally on the fear trade, but now 1260, and here peaked above 1250 and failed. And this looks to me, it's not a very strong one, but a weak here double top. You could also make a case for an ascending triangle, but or whether it's going sideways, it's a little harder to see. But look at this in gold too, massively overbought, lower high, broken up trend. This is heading back into a sideways or even a correction mode here. So 1250 to 1260 resistance for gold. Then in here around 1230. And down on the support zone is 1190 to 1200 for gold. We're basically trending sideways, but I do think you could see gold retest the lower end of this range in the coming days, particularly if the US dollar continues to advance and people start to speculate that a March rate hike is back on as a possibility. While we're on the topic of currencies, I just wanted to highlight a couple of others here. I'm going to start with Aussie dollar. Australia does have an RBA meeting this week. We are seeing this quietly picking up here, forming an ascending triangle base, testing its 200-day average. Momentum still kind of sideways here, but overall base building underway in the RSI. That's 73 here, and this up here is 73.90 or so. Anyways, if we do see a breakout, probably could even see a run up at the 75-cent level. But if we do start to see the Aussie creep up too much, don't forget the central bank could try and talk it down and take more pot shots at the dollar. So potential for volatility around that. That's Tuesday morning Australia time. Monday night in North America is the RBA meeting. So you could see some action in that around that meeting. Let's just take a quick look here at euro dollar. There we go. Euro dollar is starting to back off. People are still speculating that the ECB might bring in some kind of additional form of stimulus in at their March meeting. Now, if we go back to December, we'll see that it fell down, and a lot of stimulus had been priced in, and they brought in some, but basically the ECB disappointed, and pop up it went. We're still in a trend of higher lows out of that, and even these declines are still in this trend of higher lows. So watch out with when we do see European and Eurozone news, people are likely to read that within the lens of how aggressive could the ECB be. RSI momentum still pointing downward. But overall, it's kind of mixed here. I wanted to talk. Let's do dollar CAD, and then I'll do cable, and we'll move on. So dollar CAD here is continuing to trend lower and breaking down. It's paused here a little bit, but basically this is still a U.S. dollar weakening against CAD and CAD strengthening. And why? Because we're seeing the price of oil increase, which I'll show in a bit. Nice big breakdown here, followed by an inside day, keeps this whole downtrend structure intact. And I want to talk a little bit about the pound here. Sterling's been absolutely crushed in the last week on as this realization that a Brexit vote is for real. A date has been set. Politicians are picking sides. There's an agreement to be voted on, and now we're starting to, and so we saw that take it down. I think that's now been fully priced in. We are getting some support in here around 138.50 to 139, but it actually does have to really clear 140 to signal an upturn. We're getting oversold. Look at this, oversold on the RSI again, and a positive divergence. So in somewhere in here, maybe we see this start to bounce around between 138.50 and 140 or 140.80 here. But like a similar kind of range to what we had up here is what I'm looking at. Probably though, it does look like we're reaching an extreme for sterling. Could start to base build a little bit. I'll move now to crude oil, as I noted with the Canadian dollar, that crude oil continues to show signs of building. And look at this here. Nice double bottom, ascending triangle forming, nice accumulation. Still running into resistance here around 32.40, but look, RSI is back above 50. Higher lows indicate, general speaking, an upward trend and a nice double bottom here, and that's a hammer. So overall, it looks like crude oil's bottomed out for now. Could creep higher. If we break this 32.40, next resistance up here around 35.90, maybe the 35 level in here is more like the $34 level. So we do have some upside for crude oil on a pop. Finally, I just want to go in and show some indices and in particular some of the moves we've been having. Look at this one here for the S&P 500. This is a classic pattern. Look at this, a nice big double bottom down here. This is a W pattern. It actually even looks right like the letter W. Fabulous base here for it, and we're starting to break out. Yes, we shot up here and came back, but we are seeing a little bit of profit taking. But most important, we're holding well above this 1940 breakout point here. Upward momentum building, leveling off a little bit, but basically, even if we do get a retest here of this 1940, it should hold, and if it does, then we could see this continue to work its way higher. Let's look at the NASDAQ as well. Also breaking out here. Again, it cleared 42.25, shot up to 4300s, run into some resistance and been knocked back, and some profit taking ahead of the weekend. But basically, this is a breakout, and the breakout point is holding as new support. And finally, I'll just show the Dow here. The Dow, same kind of thing here. Again, another one breaking out of this W formation, this double bottom base, on its starting to rally up, spiked up into Fibonacci resistance here. That's a 50% retracement of this big wide channel here. Knocked back a little bit, but overall underlying uptrend still intact. Underlying uptrend still intact in the RSI. I'd mentioned that it looked as though the yen was peaking. And one market that could benefit is the Nikkei, the Japanese stocks. They had been trending in the opposite direction of the... sorry, I'm having a little bit of trouble here. Japanese stocks had been trending in the opposite direction of the yen. So when the yen was rising, the stocks have been falling. Why? Because Japan is a big exporting country, and so if we do see the yen start to come back down, look at this, we're seeing the stocks starting to come back up. So huge base here, a big plunge here, nice turnaround, continuing to break out. That was an ascending triangle, trying to break out of that. Overall improving RSI momentum, breaking 50 here, signal an upturn, and this could have a nice pop based on the fact that it's been so depressed here. Let's just look here. 23% retracement. It's actually broken through that at 16,260. 38% retracement up here at 17,150. So this does have some room to increase, particularly as the yen starts to come back off. I'll just wrap here with the UK and Germany. UK, nice base here. We are seeing a positive RSI divergence up here around 6100. Really needs to clear this 6120 to signal an upturn, and if so, it could take a run up in here at the 200-day average and this old high in the 6310 area. We'll do Germany here as well. Germany is still had a pop. It's kind of going sideways here in between about 9100 and this high here is about 9600, and then that's up about 9725, 9890. So and here the RSI is peaking up above the 50 level. So this looks like it's also been bottoming out and starting to recover. And we'll just finish here briefly with the Canada 60. With the crude oil recovering, we're starting to see a recovery in Canadian stocks as well, and metal prices. The copper price, the gold price has been up. So overall, this has been starting to turn around as well. And this is the week of the big PDAC convention in Canada. It's one of the world's largest mining conventions. So there will be quite a bit of attention today paid on this week on metals, on mining, and on gold as well. So something significant to keep an eye out there. So all in, big week, tons of news coming out, tons of speculation on what central banks might do, nice changing trends going on across a number of markets, could set up for a particularly active week for trading.